Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, a lot going on to start 2025, some selling, but then a nice little rally during this week. The inflation report that came out for CPI slowed some of the upward pressure on interest rates. We will unpack why rates were headed higher, why they have been heading higher, and why that report relieved some of that upward pressure. Fed. They said two times next year. Market is starting to wonder whether it's one or two times. We will discuss why the Fed is only expected to cut one to two times in 2025. And then sentiment, only a 5%, actually less than a 5% pullback in the S&P 500 since that peak there in mid-January. Yet sentiment data is showing that investors have become very bearish very quickly, the most that we've seen in more than a year. So on the chart here, we have the US 10-year Treasury, the yield of that 10-year Treasury. And you can see that since the start of the fourth quarter in 2024, that has been pretty much heading one way straight up for the most part, except that small little decline there in early December, late November. Reason why? Economic growth has been much better than expected during the fourth quarter, and really the entirety of the first three quarters of 2024. Unemployment, the labor market's been pretty strong. Inflation has been a little bit sticky, not dropping as significantly. We've seen some slight pickup during the fourth quarter. If you look at that short-term drop in interest rates and some of the tailwind for the market's rally this week, that's really the CPI report that came out for the month of December. On the chart here, we have the US CPI inflation year-over-year percentage. So that's how much prices for a basket of goods and services have increased over the past 12 months. And then the month-over-month percentages in that table on the top, that's just how much prices have increased during that month of December. And you can see on the chart, which is showing the year-over-year for CPI and core, just a reminder, headline CPI includes everything with food and energy prices. The CPI core takes out increases in food and energy. And you can see without that volatile food and energy for the month of December, some of those all items were actually up 0.4% for the top line, but only up 0.2% for core. When you get rid of some of those energy and food names, those are very volatile, and the Fed and most economists don't pay as much attention to that because it tends to be a little more volatile. So top line CPI grew ahead of expectations and actually bumped up a little bit in November. But if you looked at actual core, excluding those numbers, it was up a modest 0.2%, which actually a drop from the previous four consecutive months of 0.3% increase. So core, pretty good. You can see transportation, those are vehicle service, transportation services and vehicle were the major drivers of inflation for this month. But that small improvement in the core CPI was enough to sort of bat down the sentiment that economic growth and inflation was headed dramatically higher, and the Fed was going to not cut rates maybe one or two times at most. And you started to see some buyers come into the market. We're in this interesting phase here where you have kind of a balance of different scenarios. Good news around the economy is making people view it badly. We saw markets sell off because of that. And the fact that inflation is starting to subside a little bit in respect to core made people think that, okay, maybe the Fed is going to cut a little bit interest rates. All in all, it's a lot of noise, a lot of sideways chop the past 3 months for the market right now. They're trying to figure out what that next path forward and just how sticky that inflation is. Now, speaking of Fed expectations, these are based on the Fed fund futures probabilities through the end of the year 2025. That last meeting will be December 10th of 2025. If you looked at this 6 months ago, it was calling for a lot more rate cuts. Right now, they're not expected to make their first rate cut until at the earliest May, more likely June, down to 25 basis points, down to 4.25%. And you can see the majority actually thinks that's all they'll do. We'll get one rate cut during the summer or the fall of next year, and that will be it. But it's about a coin flip of whether they're going to do one additional cut next year. So with that said, very noisy. These probabilities, don't buy into them too much right now. If you looked at these at the beginning of year, last year, they were expecting 6 rate cuts. That cut down dramatically. So this year, they're entering it thinking the Fed's going to be very cautious and not very accommodative in terms of cutting rates. Time will tell. Data will ultimately determine what the Fed's going to do during the next 12 months. Now, this part was really interesting to me. Sentiment. We view this from a contrarian point of view. If we see too much optimism in the face of a rally, that warrants caution. If you see a lot of pessimism during a market upswing, that's actually a pretty good contrarian sign where the markets climb that wall of worry. So this looks at the AAII percent bearish. So for those of you that aren't familiar, the American Association of Individual Investors is a club that individual investors can participate in. And they ask once a week retail investors, are you bullish, bearish, or neutral on the stock market over the next 6 months? And the teal line are the percentage of those respondents that said they were bearish. So it was a little north of 40%. So almost half, but not quite, said they were bearish on the stock market. What's interesting is that that's the highest figure that we've received from this survey since October of 2023, which was the last sort of bottom, if you will, of a decline in the S&P 500. And what's more interesting to me is this is much higher than the 10% pullback we had in August for this, which only reached about 38%. There are more bears now than then. And we only had a 5% pullback, and you have about 40% of individual investors that are bearish on the stock market. They're really being impacted by those expectations for fewer Fed cuts and the increase in interest rates. I think anytime you see this, this is a good sign, and we're seeing some of this pessimism unwound during this final part, this second part of this week, as that CPI report came in a little bit not as worrisome as some had ahead of that. Now, for those of you that are looking to win a gold medal, maybe past your prime, maybe don't have the skill set, if you have money, you can get one too. There is a gold medal awarded to the winner of the 110-meter hurdles at the 1904 St. Louis Olympics. That will go up for auction. That is notable, obviously, because it's 120 years ago. It's a gold medal. It is being auctioned off here soon, and that's actually the first Olympic Games that were held on U.S. soil. A couple other notable pieces of information from that Olympics. It was originally slotted for Chicago, but they had the World Fair, so they shifted it. That gold medal is actually 100% gold. If you did not know that, the more modern day Olympic medals are mostly silver coated in gold. And the last bit of information I found that was great is back in 1904, the original winner of the marathon at the Olympics in St. Louis was later stripped of the medal after they determined that he had driven a car for a portion of the marathon. So that's ingenuity right there, but that also means he is a cheater. So that's no good, but if you have the money, go ahead and get yourself a gold medal here in the next few months. With that, I want to thank everyone for watching, and I'll see you next time.